I think that means that there's recording in progress. All right.
Really?
Not 100%. All right, so let me minimize this thing. All right, so I think everybody was here last time, but format, we'll watch the video and then answer questions, and I might stop. Oh, and are you guys able to see this? Let me share screen. Hey, Tyler, are you able to see this?
No, I can't see the video yet.
I know.
Oh, okay, there it goes. Cool.
There we go. Okay.
I'll take a burger from In-N-Out.
I'll take those. He's got the coolest music ever.
Very good, yeah.
Won't it out?
You want to close a couple of loans.
So hey, let's learn the mortgage market, just like maybe for the first time. There's so many things about the mortgage market that can really help you with your customers and really beat your competition. It's a lot more complicated and intricate than most people understand. So we're gonna break some things down for you right now that I think might be things that you never really thought of. So let's get into it. First of all, let's take a look at some of the things we're going to talk about, like how interest works, amortization, the skip payment method, analyzing refinances the right way, and oh, here's the big one. It is APR, one of my pet peeves, annual percentage rate. We'll get on that one, don't you worry. So here we go. So first of all, amortization. This can give you a lot of ammunition. In working with your customers, what you want to do is you want to show them the power of the amortization table. Now, I'm going to date myself here, but when I first started originating loans, I loved using the amortization schedule. In fact, I would bring amortization schedule with me, and I would do it for a $100,000 loan, and then we just do the math on it. But what that was able to do is give me so much power in showing people how they can take control of their future. You see, if you take a look at this chart here, and you see a $500,000 loan, 4%, here's your payment of $23.87, and it's a 30 year. So if we know that, what would a $10,000 one-time payment do to this transaction? So if you take a look at where we would be in the amortization schedule, let's say they did this towards the end of the first year. So there are 11 payments in, and now what they did was they made a one-time payment of $10,000 because they wanted to make an investment, and maybe they wanted to invest in their mortgage and pay it down. Now, a lot of people say, well, you know, you don't get a benefit except that it shaves some years off the back of the mortgage. It's true it does shave years off the back of the mortgage, but you do get a big benefit way in advance of that. And let's show why. So if we were to take this $10,000 and make one lump sum payment, what you would do is you would have, with that prepayment, you would go all the way down the amortization schedule. Your 12th payment would be equivalent to where you would have had to make 25 payments normally. Because I want you to take a good look at the amortization schedule and notice what happens to each subsequent payment. We know that when you make a payment, some goes to principal, some of it goes to interest. And notice how after the $10,000 payment, each subsequent payment has a greater portion going towards principal.
So does everybody understand what he's talking about? Why? So when you make a payment, a principal and interest payment, or when you have a principal and interest payment, like a fully amortized loan, the reason I can calculate what the interest portion of the payment and the principal portion of the payment is going to be. If I know what the interest rate is and I know what their loan balance is, I can calculate it for any time in the year, like any time throughout the loan. It's like not magic. So like the calculator I created for Summit, the refinance calculator, back when we were having trouble getting payoffs. I don't know if anybody was here back then, but when COVID first happened, it was taking like 2 to 3 weeks to get a payoff quote because like all the servicers were all shut down or short-staffed or getting inundated with requests for payoffs. So instead of taking like 24 to 48 hours or sometimes 72 hours, we're literally taking 3 weeks. So we needed something to speed it up. So I created a calculator that we got the company to adopt. So if you ever see like on Peak, whatever the refi calculator, I made that. But basically I just put how I would normally calculate it into Excel. So I did it for you. But the interest portion of your loan or the interest portion of your monthly payment.
Ryan.
Oh. It's $10 fee every time you get kicked out, Ryan. I'll send it to you. I'm just kidding. I don't know if you caught that, Ryan, but basically your monthly payment's gonna be made up of principal and interest. The interest portion is always going to be equal to the unpaid principal balance times the interest rate as a percentage divided by 12. So if you look at like that, let's say year 6, we got a calculator. I use this one. Okay. So year 6 on this month 6 is 495. 641. And the rate on this example is 4%, so times 0.04 divided by 12, 1652, or sorry, 1642. Yeah, there we go. Or 1652. Why is it showing 1652? And this is.
I think you did the blue line. You didn't put the like 480, 98 or something.
Oh,
You
6 right.
did 490.
Oh, right.
Yeah, you did
Yeah.
495.
So yeah, that's right. So it's always going to be like the following month. So this month's interest is calculated on this principal balance. You're supposed to go like one payment back, but see how this is 1652, 1652 like that. It's not magic. Like when people say, oh, when you take out a loan, you're paying almost all interest at the beginning.
Yeah.
That's because if your payment's going to stay exactly the same every single month, well, the interest is going to be higher when it's calculated based on a higher principal balance, right? So if your principal balance is 500,000, the interest is literally going to be twice as much as when you get the principal balance down to 250,000. So it's not that, it's just in order for that payment to stay the same, like the principal and interest payment to stay exactly the same, the portion of interest is as it goes down because you're paying interest on less principal, the portion that goes towards principal is higher. So when people, you guys probably get that, like, well, I have people that say, oh, I don't want to start my loan back over. Okay, well, you're not really starting your loan back over. If I give you a 30-year loan, you're 10 years in. This is mostly on a refinance, but let's say somebody's 10 years into a 30-year loan, and I give them a 20-year rate. A lot of people think that they're going to pay more interest at the beginning because people don't understand how this amortization works. Like they don't understand how this simple interest calculation works. They think just because it's a new loan, you're starting over with this flipped principal and interest payment. So it's important for you guys to know this because you're going to have that rebuttal, or you're going to have that objection. So have you guys ever heard that?
Typically you are, but you're going to still be keeping it under the 20 years. So
No. So when you do a 20-year loan, if I took out a 20-year loan, or a 20-year amortization, and I had a 30-year loan, if the principal balance is the same, and I'm 10 years into, like the unpaid principal balance is the same 10 years in, and I'm versus me taking out a brand new loan, 20-year loan, but I'm 10 years into a 30-year loan, the interest rate's the same, and the unpaid principal balance at that price, at that start point is the same, your principal and interest distribution is going to be exactly the same. The payment's going to be the same, the amount going towards principal is going to be the same, the amount towards interest is going to be the same.
right,
So you're not starting
doing a 20-year term.
Because you're doing
versus another 30-year term.
Yeah, exactly. So
So you're just saying that you pay the principal down. So no matter where you're at, no matter how long the loan is, the principal is the same. So the interest payment is
exactly, saying your monthly payment's going to be the same if it's the same loan term. So you're taking out, you're doing a new 30-year loan. Yeah, you're going to extend the term. You're giving yourself more time to pay back that principal, and you're going to pay more interest over time. But this is just
but
important.
you're
For,
not paying any more interest besides the longer term.
exactly. So this is just important. So when it does come to bring Elijah
You're
in.
paying, I guess you would say.
Yeah, because I do get this.
So what do you tell people when like someone says, hey Josh, like I don't want to do your refinance. Oh, you should do refinance, Jared. Josh, I don't want to restart my loan again.
I say I understand, I get that all the time. I get this question all the time. And let me show you why everything you've ever heard is wrong. And then I break out this amortization table and I do this calculation and I show them. And I'll tell them, hey, right now you're gonna learn something that almost nobody knows about. You can go talk to 10 loan officers and they probably are gonna think the same thing that you just told me. But this is how it works. And let me show you why you need to be working with me. And you need to be working with me because I can actually understand this. I can explain it to you. Other people, they just go with whatever they're told. And it's going to put you in a bad position. So I want you to make sure that you understand how this works. And you're not just going, okay, yeah, I'm going to start my loan up. Like, let me show you why you're not starting your loan up. But all right, let me start that back.
See, this is something that most customers don't understand. It's not the $10,000 itself. The reason it becomes magical is because it's got this compounding effect. Every single time they're going to make a payment, they're going to keep more of their money. They're going to spend less in interest. So when you skip 13 payments, it really is at the cost of approximately 4. Let's say if that payment, which is, let's say, almost $2,400, 4 payments would be a little short of $10,000. Yeah, but for that $10,000, they're skipping 13 payments. What would be effectively worth 4? They would get the benefit of $31,000 by the end of the loan. They'd save 13 months worth of payments at the end of the loan. Amortization can really be used to help your customer understand how they can create wealth, how they can meet their retirement needs. Maybe they've got a goal that they'd like to get to where they own their.
Usually I just show them the total interest paid back on both scenarios. So they realize and they see, okay, if I do this, I'm paying this much. If I do this, I'm paying this much less.
So you can look at the aggregate figures, but most people, you want to simplify it for them because they could easily say, well, I don't plan on having this loan for 30 years. So if you can show them, hey, if I start this loan, if I do this loan, let's do a 25-year term. And just so you guys know, in case nobody else knows this, we don't, like if it's a conventional conforming loan amount, it can't be like a FHA, it can't be a Govy loan, it can't be a jumbo loan, but if we are doing a conforming loan, Summit funding, Fannie Mae, if you want to do the loan, if you want to do a 26-year, 4-month loan, we can actually do that loan with that exact term. We don't have to do a 25 or a 30 or 20. Does everybody know that? I ask these guys too.
We refinance whatever the same year is.
Whatever they want. So if somebody wants to pay off,
Is there a specific name for that kind of loan?
no. So anybody ever done that before? Or any of you guys ever done that before? No. Okay. Let's just assume no. So yeah.
I want to know how common that is for people to be able to do that.
I have no idea. Like with other banks, I have no idea.
Other banks won't even give them that option.
I imagine, but the pricing is this. The pricing. So if you're looking at the pricing, if you do a 26-year loan or 26.5-year loan, the pricing is going to be the same as a 25. So you go to the next closest, or actually,
No,
no,
30.
30 years. So yeah, if it's the closest 5-year or whatever. So if you're doing like a 18-year loan, it's going to be based off a 20-year, like a 20, whatever your pricing is for 20-year. If you're doing like a 10-year loan or a 12-year loan, you could do it would be 15-year pricing. But when you lock something in Encompass and it says, do you want to, is this a manually, you guys know, you have to click that,
Okay.
is this a manually
That's what you
generated one? That's where you would say yes. And then you have to send it and locked us with it. But just if you have somebody that just is not understanding how the amortization works, because there are people that are 1 year in or 2 years in, they're like, I don't want to start my loan over. Okay, and in this, if you explain this to them and they don't understand like why they're not starting over or how they can just make a specific payment and stay on the same track, then you can do that for them. And it gives you an opportunity to not lose that loan just because somebody's in their ear telling them misinformation.
So do they sell that off as like how they package that?
Yeah.
That's a different question.
Yeah, it's a different question. We'll get into that later on about, so when you get into something called, well, when we get into mortgage bonds and the maturity of the mortgage bonds, that will come up.
So if they did pay those 10,000 prepayment and this is 13 months early, right?
Yeah.
Or 13 payments are gonna skip. Would that just shorten up the term or is they gonna just string out the payment less?
Well, no, so you would pay less, and you pay a lot less interest overall.
No,
because-
no, at the end, like let's say they got 30, would they scoop it up to that 20?
They reduce their payments by 13 months.
They reduce the payments, not the.
They would
not the
reduce,
term?
They were reduced to term. But if you
So
want,
they finished 13 months early.
yes, but you can opt, and if anybody doesn't know this yet, there's something called a voluntary recast. You guys ever heard of that?
Yeah.
Yeah, no, Dustin has, because okay. So let's say
Voluntary what?
recast,
Okay.
RECAST, recast. So a feature of interest-only loans is that they recast, meaning they recalculate based on whatever the interest rate is, the term or whatever. Like if somebody makes a principal payment on an interest-only loan, your monthly payment will change because it's interest-only and it's based off of the principal, right?
Yeah.
Well, if you, let's say, pay $10,000, this is usually for a lot bigger payment, but let's say somebody had $100,000 windfall and they want to put their $100,000 into a mortgage, and they don't want to just pay less interest over the life of the loan and pay it off faster. If they actually want to see their monthly payment go down, you can request from the servicer, again, only on conforming loans, like only on conforming loan amount. You can do it on jumbo loans too, most of the investors, but you just reach out to the servicer. You say, I want to recast my loan. It's a one-time fee, about $500 for most investors, and they'll actually re-amortize your payment based on the existing loan term. Like, so if you're a year in and you throw $100,000 at it, they will keep your loan in 29 years left, but they'll adjust your monthly payment to reflect that balance. So like if somebody's going to sell their house and they're contingent, but they're like, oh, I want to put 20% down, but I don't have 20% right now. I don't want this higher payment. We did this with one of Dustin's customers.
Oh, yeah.
Yeah. So we did this with one of Dustin's customers. I can't afford that payment. I want to sell my house first so I can put that money down so my payment's lower. Well, they can do that later. So that's actually very important. That comes up. Somebody is contingent or they want to go contingent because they want to put a bigger down payment and keep their monthly payment on the new house lower. They can do that later. And you have to just explain that to them.
So when you do that, like then you put like 20 down instead of like 80 LTV, would you have to put like a little bit more to drop off like the MI? Is that okay to do?
You would have to petition the MI off, but if you pay that down, they will remove it.
If it's a conventional, if it's a FHA,
If FHA, no, you're never going. FHA has lifetime mortgage insurance. You have to refinance it into a new conforming loan. So hopefully that
and
helps.
most servicers will have a minimum
And
requirement
for a
of
specific
how
time.
much
Yeah.
they put in.
But
So usually at least $5,000.
they don't want to take the 15 year because either they don't qualify or they're uncomfortable with the obligation, but they know from time to time they're gonna get bonuses or they're gonna come into some money. So they can achieve the same objective, just show them how to use that amortization scheme. Now, sometimes people will say, hey, what about a bi-weekly payment? There's something magical about a bi-weekly payment because I know it's gonna accelerate my mortgage, I'm gonna pay it off sooner. How does just taking my payment and cutting it in half do all that good stuff? Well, there's no magic to it whatsoever. And you do not need a bi-weekly mortgage payment plan. See, what if your competitor is out there and they're talking about a bi-weekly mortgage payment plan and maybe you don't have access to one and your customer's about to leave you to go to that competitor? Well, you can make your own bi-weekly. That's right, you can do the same thing because what does a bi-weekly do? The bi-weekly is taking a half of a payment and paying that half a payment every other week. Let's do the math. There's 52 weeks in a year. So that means you're going to be making payments every other week. So it's 26 payments, each consisting of a half of the normal payment. That means you're making 13 full payments a year instead of 12. You want to make your own bi-weekly payment? Simply add one payment a year, and it is the exact replica of what a bi-weekly payment plan would do. So you don't need to lose any transactions, and you can explain this to your customer.
What'd you say?
That's not 100% true because the servicers, some of them don't have the software and capability to actually apply that half payment. So what they've been doing is they've been holding it and not applying it until they get the second half of it.
Yeah, so if they do that, technically, yeah, it
And
would
that
be
defeats
adjusted.
that purpose.
But so there's a difference. So this is when this came out, Fannie Mae and Freddie Mac, they still had because this is not that old, but there was a recent development. Fannie Mae and Freddie Mac stopped allowing you to deliver loans with a built-in bi-weekly payment. Right? And so if you used to be able to deliver a loan, and that's like how it was set up, but nobody ever did it. It cost too much to have that available for them to like keep whatever infrastructure that they needed to be able to service those. So basically people usually just make you pay one payment ahead and then you can make the payments. So if you make the one payment ahead, you're never behind, and then they can apply them as you go along. But the way I explain the biweekly payments, because I do get this question a lot as well. They say, if you think about it this way, if you've ever been paid biweekly, like twice a year, you get that bonus check. You get paid 3 times in 1 month. That's basically what you're doing. You're paying with that extra bonus check, you're paying that towards your mortgage. So you're making 2 extra bonus payments, 1 extra month, and you can do the exact same thing yourself.
So on average, obviously you have to do the math, like $500,000 loan amount at a 5% rate, bi-weekly payments, it reduces the term by 5 years.
Something like that, 5 or 6 years.
Something very simple. Now, I want to talk to you about refinancing because this is an important one. We do so much refinancing, and yet people are given misinformation, and it's not your fault. It's the fault of the way that it's taught. Let's use an example because I think that's the best way to go here. So let's say you have a customer, they purchased a home a year and a half ago. The purchase price was $500,000. The loan amount was an ADLTV at $400,000. And now because rates have gone down, they can refinance and save money. Heck, they can refinance 7/8% on a 30-year fix, and that's going to save them $337 a month. They kind of like that deal. But what about a 15-year? That's going to save them even more money, 1 3/8% in rate, but because the term is shorter, it's 15 years, they're going to now pay an additional $620 a month, more than what they're spending right now. So if the closing costs were $33,700, and they were looking to that 30-year fix and said, I'm going to save $337, you're probably pretty good at math. You could do some in your head here. My question to you is this: how long is it going to take for them to break even on their closing costs now? Closing costs, 3,370, monthly savings, 337. How many of you would look at that and say, oh, that's easy. It's 10 months to break even. Well, I don't blame you for saying that, because in fact, that's the way it's taught. If you look at the actual textbooks, it tells you to do exactly that. Take the closing cost and divide it by the monthly savings, and that's your break even. Think of it is people who make textbooks oftentimes aren't very good at math. And I'm not saying this is an easy one. You have to look deeper. This is something where what we want to try and do is understand what we're comparing to, because you're taking a cost and closing costs, and you're dividing it by monthly payment, which is not all cost. You see, your monthly payment is made up of principal and interest. If you take a look and you see, okay, what is the actual cost? Interest is the only actual cost here. So if you see this transaction here where it's $1,588 is the interest that they're currently paying, and the new loan's interest would be reduced all the way down to $1,134, the savings would be $454 a month. That's how much you're saving in cost. The $337 is payment. So you're saying, okay, so where's the additional dollars going? It's going to you. It's your own money. It's principal. It's not a cost. So the right calculation isn't the 3,370 and divided by 337 savings to come up with 10 months. That's wrong. It's taught wrong. The right way is you take the 3,370 in closing costs and divide it by an interest savings of $454.
Just real quick, I'll just mention, know your audience, because I've done this several times with
Get confusing.
I've done this several times with engineers, and they love it. So I explain why there's a difference, why the break even that somebody else gave them is incorrect. And I tell them, I just want to make sure that you understand why that number is not accurate. Because they'll quickly, like when you're on the phone with them and you tell them you're talking about a break even, they'll calculate it ahead of, like they'll calculate it with, like, say, oh, it's gonna take me this long to break even. Then you throw it at, like, let's say an engineer, somebody like that, they will be impressed with you. Like, okay, well, actually, just so you're aware, that's not actually the case. Let me show you how to calculate it. You do this, then you gain credibility, they trust you a little bit more, and you provided additional value. But if you try to do this with your, like a normal customer, some 60-year-old lady, like you're just going to confuse them. So don't even dig in. So this 100% is valuable to the right person. It's going to be your engineer type person. I can show you how to calculate it later on.
And what you come up with
That's fair.
is that between 7 and 8 months is when they would break even. And just showing this to a customer, something as simple as this, which is the right thing to do anyway, is what you show. If you just were to take this and show this to your customer and make it very simple for them to see the difference, when they get bad information in the competition, they've got to start thinking about what else is going to be bad information. What am I going to miss if I don't do business with a certified mortgage deposit? what are they gonna miss if they don't work with you? They can now evaluate this correctly. It gets them thinking that, man, I need to pay close attention when you're speaking. So let's take this a step further. When we take a look and we say, okay, what about a 15-year? Now, how would I ever evaluate a 15-year? Because I'm not saving money, I'm actually paying more. And that's why you have to look at the same thing, the interest savings. Notice the interest savings are even greater on the 15-year. It's $827 a month, so your break-even period is much shorter. It's 5 months or so to break even on this transaction. And that's where the difference comes in again. As a certified mortgage advisor, we are able to tell people the correct amounts. Most people can't do that.
I'll just try not stopping us too much so we don't get cut off, but the way I sell this on a 15-year is not what he's doing, because this is a lot more complicated. If somebody tests you on it and they understand it, and they test you on it, it's good to know how this works. So your payment's going up, but the interest you're paying is going down. But the way I sell a higher, like a shorter loan term, like somebody paying more to do a shorter loan term, is what Cynthia said earlier, is you calculate the total interest paid over the loan, and then you just compare that to what their remaining amortization, what they would pay. And it's usually a big number, like tens to sometimes hundreds of thousands of dollars.
Yeah.
So it's a big difference there, but that's a lot easier way to sell it than to go through all this. Because a lot of this, if you're going to go this route, you really need to have like visual aids and stuff to keep people engaged and following.
Really quick, going back to that, that's not 100% true as far as the 454, because they're starting amortization at 30-year again.
No, because remember, it's just the interest payments. You're only the break even is interest. Interest is the cost of money.
Right.
So the cost of money or borrowing money is interest. So you're only going to calculate that. That's the only thing you're going to compare.
We'll go back and visit that.
Yeah.
Still says that.
And now, there's another situation that this could come up, and that's with a no closing cost loan. Now, listen, I think no closing cost loans are awesome, especially since I'm the one who introduced it to the mortgage industry way back in the early 90s when I had my show on CNBC and started talking about it. And everybody said, that's impossible. How do you do it? I really started talking about it over and over again. It became pretty ubiquitous within the mortgage industry. Well, now with prepayment speeds accelerating, it's difficult to get more above par pricing to encompass some of the closing costs, especially on your smaller loan amounts. It's very difficult to do so. What if there was a lender that was competing against you and they had a no closing cost solution, but you just couldn't do it? What do? Lose the transaction? No. Use your skills as a certified mortgage advisor to show them the breakdown and be able to illustrate to them that it is true that in this particular case, that no closing cost mortgage, which is in that lighter color of teal, would be better for the first 17 months. But Mr. and Ms. Client, while it's true that the no closing cost is better for the first almost year and a half, how long do you think you're going to be in this home? Do you feel that you might be in this home for longer than a year and a half, or have the same mortgage for longer than a year and a half? Because if you think that's the case, well, then you should be paying a closing cost because it's better for you. All the customer needs to do is have a chance to see this. And that's what's really important. Now, here's another problem that you have in a declining interest rate environment. Everybody all of a sudden's got a crystal ball, and they've got their own opinions, and they hear somebody on TV say, oh, don't refinance now. Rates are coming down. What people forget is they forget to consider the amount of money they could start saving today. And even if they're right, even if interest rates do decline, they'd have to make up for all the savings that they've lost. Or what about this one? What about if somebody waited and they finally refinance with you, but then rates drop after they start refinancing with you, and they want the lower rate and they threaten to leave to go somewhere else? What they fail to realize is if they're going to start the process over with somebody rather than close with you right away, the savings that they would have had now has to be made up by that incremental gain that they get, and that takes a long time. You need to be able to do the math and evaluate it. So here's an example. They purchased their home 4 years ago for $437,500. The loan amount was $350,000. The rate was 4.5%. And here's their payment at $1,773. If they refinance today, they could save $355 a month, taking the rate from 4.5 to 3.25. Seems great, but wait a minute. I think rates are going down. They're going to go to 3 1/8 or 3, so I'm going to wait, right? Let's do the math for you. Because if you did wait, let's just say you waited 6 months and you were right, rates did come down. A drop of 1/8% would mean that you get a lower payment. You get an incremental savings of an additional $37, but now you have to make up the time. It's gonna take you 5 years to break even. And it's risky. What if you're wrong? Is it worth it to wait 5 years? Is it worth it for you to put yourself in a position where this is, if I get it, I've got to wait 5 years to then save $37 a month? Obviously not worth it, but people won't be able to evaluate it unless they see it. See, it takes a certified mortgage advisor to be able to show them the difference. And when we take a look at this here, even if the difference were 0.25% differential, it's still going to take you a lot of time, 3.5 years to save to start saving $58. So these are all things, and remember the risk that's involved too. So eliminate the risk, give them the short term, and start saving money today. This is the key that a mortgage can provide for an individual if they just understand it by closing and refinancing today as opposed to waiting. Now, one of the things that we want to talk about is the skipped payment myth. I hear it all the time. I hear people almost advertising, refinance, and you're going to skip a payment. Sometimes they say you're going to skip 2 payments. I see it all over social media. I hear it, I'm overhearing in phone conversations. I hear customers that have said this is what they were told by their mortgage professional. Well, I'll tell you what, they weren't a certified mortgage advisor. I promise you that. Because certified mortgage advisors know better. They know that you never skip a payment. What do you think? There's a free lunch here? Of course not. I used to take this exact same example and show this to my customer on every refinance, and I really suggest that you take the time to do so too, because it really clarifies it for a customer. So let's pick any point in time. Let's say my customer is closing on May the 6th. What you have to understand about a mortgage payment is the mortgage payment is interest, which means it's paid in arrears. It's a fancy way of saying it's paid after the money's used. So here's an example. Let's say you go to a bank and now you want to deposit some money that you're going to get interest on. So when you give that bank your money, you don't say, here it is, here's my money, give me my interest right now, right? No, it doesn't work like that. The bank uses your money for a month, then they pay you your interest. Well, it's the same thing here. Now, what you're doing is you're using the bank's money. You're going to wait a month before you pay interest. See, rent is paid the first of the month that follows. A mortgage is paid the first of the month that just passed. So when you close in this particular transaction on May the 6th, you owe money for the month of April, which would have been due May 1st. So if you didn't make May 1st payment, you're not skipping it. You owe that. It should have been paid April 1st. It should have been paid May 1st for the month of April. But if you didn't pay it, you darn well know that at the closing table, they're going to collect it. They're going to add it to what you owe. But what about between the 1st and the 6th? They're not getting off the hook for that either. You've got to pay that at the closing table too. So all that money, called interim interest, that's going to go to the previous lender. And that's going to make them happy. Now you're paid off. Now we know that mortgages are paid on the 1st of the month. We know that they're paid in arrears. Now, realistically speaking, if you're closing on the 6th of May, your first mortgage payment really should be June 1st, but it doesn't work that way because lenders want it nice and neat, everybody to be paid the 1st of the month. The thing of it is, when June 1st comes around, it's an odd number of days. So you know what they do? They make that easy. They say, here's what we're going to do. We're going to take that interim interest for that odd number of days interest from May the 6th till May the 31st. And guess when we're going to collect it? We're going to collect it for that period right at the closing table. And that's going to cover you through the end of the month. This is the first time, that's why it's handled differently. It's an important concept for you to understand. This is the first time where interest will be paid in advance. And it's the only time in the mortgage that interest is paid in advance. It's called an interim interest charge. There's consequences to the fact of them collecting it in advance.
So real quick, does everybody understand this? Because this is important for a few different things.
So like, is that like similar to like prepaid interest?
Yeah, it is. So I don't know if you guys ever had this question, but people ask, okay, well, I'm closing in the middle of the month. My first payment date's this. Like, is my payment going to be different for the first payment? Like my first payment is still going to be higher, right? Like, no, your payment's always going to be exactly the same, but we are going to collect the per diem interest to the first payment up front. So in this right now it's May, so first payment would be July 1st. So if we're closing today, I would tell them, you're gonna pay the 4 day, because they'll ask, what are these other costs? Everybody asks like the closing costs, like if it, when you're looking at your LE or your CD, they'll be like, oh, why are the closing costs so high? I thought you told me the closing costs were only $7,500. Well, why does it say it's 16,000? Well, we've got prepays, now we've got property taxes, insurance, all stuff that should be coming up during your professional home buyer presentation. But that this is something you need to be able to explain to them and say, okay, you've been renting, right? But when you rent, you're paying for the ability to stay in that property, to live in that property for the next month. So you're basically paying for next month. When you're living in it, when you buy a property or when you're refinancing property, you're paying for the month you just live in the property. It's the exact opposite of rent. So if we're going to be paying, let's say your first payment's going to be July 1st and we're closing in the middle of May, there's going to be 15 days of interest from May 15th to June 1st. June 1st to June 30th is going to be paid. All that interest is going to be paid on July 1st. July 1st, you pay for the month before. So if we're closing in the middle of May, we have to cover from May 15th to May 31st. June 1st to June 30th would be paid in July. So that affects the APR too. He gets into that. But when people say like your APR will change based on the time of the month that you close. So it's the people, that's one of the ways that I usually explain, because people ask, what's your APR? Oh, what's your rate? Okay, what's your APR? One of the ways that I kind of get them away from that is like, well, it depends. I can't tell you exactly because I don't know what time of the month we're going to close, but which day of the month we're going to close. Your APR will change by that. Okay, what do you mean? And then you can kind of get into that. And then if somebody else tries to sell APR, they sound like they're trying to cheat.
So this is the same thing as prepaid interest on a purchase, but now you have to pay the interim interest as well.
Yeah, exactly. So you're paying, like when you have a payoff quote, your payoff quote is usually through a certain period. So let's say they didn't make let's say they haven't made their May 1st payment. So right now, the May 1st payment is due, that would cover the interest for April. This is a refi. So you'll have April 1st to April 30th, plus you'll have May 1st through whatever date you're closing. And so you're gonna have almost 2 months of interest built into the new loan, so you're gonna have to prepay that. So it's not, you're not skipping anything.
So if this was a refinance, then you get hit both on both sides.
But it's no different than, yeah, I mean, but like with rent, you're getting hit with the rent.
Yeah.
And like, but you're always, on refinance, you never move out of the property.
Correct.
You're
So you're
still paying it.
you're still-
So I'm saying you're getting hit on both sides then.
Yeah,
But if you're a buyer and seller, then only the buyer would get hit.
exactly,
And then the new purchaser would take the front.
exactly.
Okay. Just want to make sure I'm saying.
But the reason that I like to use this is just to create credibility also, so you can explain to people. So when he says, do you skip a payment? Like, oh, I heard I get to skip a payment. I always say, well, I hate that word. Like, I hate saying skip a payment because it's not really accurate. And I quickly explain it.
There's no free lunch.
So, but they'll say, but can I still skip a payment? Almost all, but I don't have to make a payment, right? No, I mean, yes, you will not have a June 1st payment, if that's what you're asking. But if anybody tells you you're skipping a payment, they're either lying to you or they don't understand it.
Disposing it to you.
Yeah, so that way you make everybody else sound like they're either trying to rip people off or they don't know what they're talking about. So that's the point. Okay, I gotta keep this going or.
Now, when June 1st comes, are you making a mortgage payment? No, because your month of May was split on May 6th. You paid it in advance on May 6th. You paid the old lender from the 1st to the 6th, that closing on May 6th. You paid the new lender from the 6th to the 31st on May 6th. So if somebody says, hey, wait a minute, I'm skipping a payment, you're not. It was already paid. You just paid it in advance. Hey, I'd love to tell you if I paid my cable bill on the 6th of May, that when June 1st comes, oh, I'm skipping it. I'm not skipping it. It was paid in advance. And that's the misunderstanding that so many people have that's conveyed to borrowers. And then they go as far oftentimes as to use it as a marketing ploy. And that's just wrong. Now, while that might get that particular lender who's doing this the improper way, maybe they might fool a few people and get some more transactions. Not only is there a moral issue with this, but think about how much good you could do and how much better that you're going to look as someone who's honest and understands it, as opposed to someone who doesn't. Hey, they could even be honest, but if they don't understand it, they're just dispensing bad advice. So now, when's your first mortgage payment? Your first number one mortgage payment on this transaction? Well, it's July 1st. For the first full month that's uninterrupted for the month of June. And that's how it works. Now, this is a simple example. But it means so much to your customer if you go through this and you're able to explain how your customer will benefit from being able to put themselves in a position of now getting the fact that their payment at the closing table on May 6th really is just the payment in advance for the previous month, and they're catching up for the month before. That's what certified mortgage advisor does.
Nice, so we're doing all this, but if we want to get the CNA designation, we got to, get the pay membership fee, right?
Yeah, it's $1,500 for this course.
Oh, that's it?
Yeah.
That's just one time? and
One time.
Get the CNA, and then-
I mean, you have to actually do the course.
Oh, yeah.
But yeah, you'll get the designation certified mortgage advisor. I think the information just
Debt consolidation is really at the core
value.
of a financial plan. You know, you can look at yourself as a mortgage salesperson, or you could look at yourself as a debt manager. And in order to be a really good debt manager, you have to understand debt consolidation. Because managing debt is something that can be even more powerful than managing assets, like the financial planner or stockbroker could do. So we have to know that debt consolidation can almost make you immune to interest rate changes. Because people are going to be in a position where the interest rate that's available in the market may not be as beneficial as the interest rate they have, because rates may go up after they close. But there's a whole other aspect, if you look at the equity that they have in their home, to create wealth. And that's what debt consolidation is all about if it's done correctly. Even if interest rates are higher, it can create an incredible amount of wealth. You can change your customer's life. You can do so much good in the world simply by understanding this. And the good thing is that so many people have so much equity in their homes that's just sitting there, trapped. In some cases, it's okay if it sits there. But in some cases, that equity, if just simply altered in the way it's used, can be life changing. So let's take a look. Sometimes it's a good idea to do an annual review with a customer. When you do, what you want to make sure is that you look at their debt picture. You're not just doing an annual review to say hi. You're not just doing it to see where their rate is and what the rate you have is. You want to look at their debt picture. And remember, everything changes for your customer, doesn't it? I mean, think about your life. Your life the same as it was a year ago, 2 years ago, 3 years ago? Things change.
More farm markets closed.
Situations change. Personal, employment. These are things that you can help that customer adapt to. Now remember, you should have already set this up because it's always a good idea to never do one loan at a time. You got to do 2 loans at a time. You got to think about the loan you're doing in a moment, and then how it's going to work in conjunction with the next transaction you'll be doing for it. So that's all part of your annual review. And when you do this annual review, what you discover is their current rate 3.5%. They bought a home 3 years ago for $500,000. That had an 80 LTV, 400,000, and their estimated home value today is a little higher because of appreciation in their specific market, and their remaining loan balance through regular normal amortization is down. So the interest rate in the current bond is at 4.5%. So if you're looking at this, say, when their right mind is going to go from 3.5 to 4.5%, and they're not even paying mortgage insurance, why would that happen? And I don't blame you for thinking that way because their payment's going to increase. The payment's going to increase by $127 a month, but there's more. Let's even throw $4,000 worth of closing costs on them. So why would somebody do that? It seems silly. It doesn't make sense unless you take the approach of a certified mortgage advisor and you're going to be their debt manager. So all you're going to do is call that customer up and talk to them and say,
One thing I'll just mention real quick. So this, there's a really good tool in Mortgage Coach to do this. So right now, on Rosa Sarag, one of my refis, I'm taking her from 3.375 to 5.375. And I'm only pulling out $75,000 in cash. And it didn't in my head, I wasn't sure if it made sense. And then until I got all the information from all of our credit cards, everything we were paying off, all the debt consolidation, I couldn't have told you if it made sense. But once I put it all in the system and I put together the presentation through Mortgage Coach, it did make sense. She was actually saving quite a bit of money.
So does it get like a lot more difficult if the person's actually working towards paying off those debts instead of making like the minimum payments? Because then they're gonna pay them off.
That becomes more hard, becomes more difficult to project like the total cost, because if that payment's changing, if they're using whatever, if they have any like additional income, like bonus or whatever, and they're applying that. Yeah, then it gets a lot more convoluted, but if you try to keep it simple, because it's already going to be a complicated topic to explain anyway.
You never include something that has like 5 months left, you know?
No, you can, but you'll see like in Mortgage Coach, it actually tells you this is how long it would have taken you to pay this off, or after this amount of time, you would have all these cards would have been paid off, but there's still these ones remaining. But also you can reinvest. So if you reinvest the savings, the payment savings back into the mortgage, there's a number. Or in her case, I told her, I was like, I know for a fact you guys are not going to pay more on your mortgage. Let's just be serious. We talked about this last time. You get to do it, you're not going to do it, right? She's like, no. Okay. So I was like, well, how about we put that money into an E-Trade account, and we get like a standard like S&P 500 return. We leave it in there. How about I can still pay off your mortgage in 15 years? Let me show you how. And that's in Mortgage Coach. We'll get into that later on, but I'll show you guys if you want to see that her presentation. But we literally brought her up 2% in rate, charged her not only total closing costs, but a point on top of it, and it still makes sense.
How many debts? What do you think the answer to that question is going to be in the vast majority of cases? And say, yes, I do. And as you start looking at the debts that they have, let's just use some benchmarks here. Let's say they have one car loan, not two, just one. And it's a Chevy. And right now, the average car loan in the United States is in the mid 30,000. So let's say their balance is even less than that. And then they've got 3 credit cards, a Visa, MasterCard, and Discover for a little over $20,000. Typical customer. And they purchased some stuff at Best Buy. They've got some money they owe on Macy's. On top of that, they've got another debt. That other debt can be student loan. It could be child support. In this case, let's just say it's alimony. So this, hopefully to you, while every single situation is different, we get that. But it's a good representation of a typical customer profile. So when we take a look at this, and we look at this overall scheme, on the top left, what you'll see is their current balance, $375,000. If we incorporate the $4,000 in closing costs, that would increase the loan amount to $379. So from $375 to $379 includes the $4,000 closing costs. And then if you look to where the monthly payment differential is, they lose $127 a month. It doesn't seem like it's in their best interest to do so, but take a look to the left of that $127 per month negative, and you'll see the loan to value. Well, remember when they purchased this home, this was an 80 loan to value. They put 20% down, 80% loan. But through amortization and appreciation in their area, today they're at a 61% loan to value. They've got 39% equity. And of course, there's different limitations on cash out refinances, but I think it's pretty safe to even take a benchmark of 75%. So now they've got a 61 LTV. You could take them up to a 75 LTV, and that's, as you can see under the 61% there, that's already calculated for it's $89, almost $90,000 in cash. So what if we deployed that money wisely? Instead of it sitting in their home, what if we took it and paid off some of their debts? Let's use some of that white space between the green bar at a 61% LTV and bring it a little closer to 75 and click on that Visa payment. Well, if we just clicked on that one and paid that off, you can see the loan amount increased now to $390,000 because we incorporated the Visa. But their monthly payment now is actually saving money at $188 a month. Well, that felt pretty good. What if we did the other ones? Now you could save this customer almost $1,400 a month. Now you notice the alimony there. This tool is smart enough to know that that sucker's not going away, okay? You're stuck with that one. You can't easily refinance that one away. But still, $1,390 a month is something that's going to clearly pique your customer's interest. And when we look at that, we could even take it a step further, because look to the left of that 1390. You see some more white space there? There's another $32,000. They're at a 70 LTV if they did this. We could take them a little higher. Maybe the question that we might want to ask here is, do you think that you may want to make any home improvements? And if you click that little box to the right of the 70% LTV, it will know where that client is because you put in the address, and it will know what popular things are happening that people in that market are doing. In this particular case, we put an address that was in Seattle. And it knows that people in Seattle are doing some of these home improvements and they're not doing some. So in many markets, people love to do finished basements, but that's not the case in Seattle. And in-ground pool, not the case in Seattle. What do people like to do in Seattle? Evidently, most people are doing renovation of their bathroom. Customer says, yes, I do want to do that, but it's $15,000 in cash I don't have. Well, guess what? We do now. Because if we do this refinance, you have all that money that we can now use for this from the refinance. And when you do, we're not going to save them quite as much as we did before, but we can still save them $1,314 a month, because why? We've had to increase the loan amount in order to do the home improvements for the bathroom. Now, while $1,314 a month is a very significant savings, and that will have an impact, think about this. You know, that customer, they weren't even considering doing this refinance. They were delighted with the low rate that they had. Mortgage rates were higher. They were comfortable with their payments. The ratios were low. So this is just found money. It's a gift of $1,314 a month. So what if we took this one step? What if we said, make believe that none of it even happens? Let's do this, but don't change your habits. Keep making the same payment you are now. And what you'll do is you'll take that extra $1,314 and apply it towards principal and accelerate the payments. Remember when we looked at amortization, how you skip down the amortization schedule, and then every subsequent payment, it's even more principal. So it's a snowballing effect. Let's see what that does. So if we were to take a look at that and apply it towards principal, well, now the new mortgage term would be 14 years and 2 months. In other words, we'd save them 12 years and 11 months worth of payments. So we're going to take their current loan and their debts, roll it into a new loan. And instead of 27 years and 1 month remaining, they've got now 14 years and 2 months to save them 12 years and 11 months. Expressed a little differently in the number of payments, they owe 325 payments. You're going to cut that to 170. You're going to save them 155 payments. What? How much are these people going to love you when every first of the month, 155 times, there's no payments to be made thanks to you. You're keeping them every payment the same right now as well. So there's no change. But you're saving 155 payments. Is this the best retirement plan in the world? Potentially. Now, you don't have to wait 14 years and 2 months to pay the mortgage off to see a benefit. You don't have to, because it starts immediately. And after just 5 years, if you hang up the phone, Mr. and Ms. Customer, you don't do anything, guaranteed, you're going to amortize $45,000 on this mortgage. But if you just take the same exact payment you're making now and just restructure your debts a little differently, you guaranteed will amortize $128,000. That's a tax-free benefit to you over 5 years of $82,000. Do you have any other investments that is going to do that in a guaranteed way? By the way, it doesn't matter what the Dow does. Doesn't matter what the S&P or NASDAQ do. Doesn't matter what the bond market does. Doesn't matter what gold prices do. This is guaranteed. All you have to do is make the same payment. And after 10 years, guess what? Well, it's an extra $188,000. And when this loan is done, 14 years and 2 months from now, it's almost $300,000. Would you like to have an extra $300,000 just from this client? I notice you have a beautiful 2-year-old child. One of the things that parents do is they worry about college education. Well, with $300,000, help make sure your child has a great college education. How about your own savings? Do you have enough for retirement? Would an extra $300,000 be helpful? Because what's changed? If you think about this, what's changed? They're making the same exact payment they were making before. It's just smarter because they're talking to you. Oh, wait a minute, one thing changed. They've got a beautiful new bathroom. There.
One thing I'll just add to this, because you want, again, to speak to your client, speak to the customer. If you have that customer comes in with a kid, I'm gonna talk to them about not putting this money towards the principal in this case. I'm gonna talk to them about the 529 account. So like a college savings account. This guy can show them, hey, I don't know what your kids' plans are gonna be for college or what your plans are for them. But if you did want to send your kid to college, we could do this. You're gonna save $300 a month on your monthly payment. Let's say we're doing debt consolidation. We're just doing a rate term refinance and we're gonna save $300. This is what would happen if you took that $300, set up a 529 account, put it on auto pay. It's coming out of your account every single month. By the time that they turn 18, like this is what you're looking at, and then you can do like a principal reduction because it's not like they're going to take that big lump sum as soon as they turn 18. It's going to dilute over time, right? So you're going to have like principal reduction like as you're using that money, but it's still going to be growing at that time. So like you can just show them, hey, you just do exactly what you're doing right now. We'll refinance you. Nothing changes with your monthly payments. Nothing changes in your lifestyle. But now your kid's got $250,000 for college. Do you think that little guy wants $250,000? Or if they're not maximizing their 401k, as part of our first-time homebuyer presentation, you should be talking to them about the importance of a 401k if they have one established by their employer. Say you're not putting your money into 401k. Let me show you what this will do for you over the next 20 years if you just start contributing to it, and this will pay for it by itself if that's the case. So, but you think of it just that in different ways, but apply it to your borrower. If they don't have kids, don't talk to them about a 529 account. If they don't have, if they're 70 years old, don't talk to them about a retirement account. So, but it's something that you should think of.
They're happier
or
every
think
morning.
about.
Home's worth a lot more. All making the exact same thing that they're making right now. Remember, this wasn't a windfall in rate. This was taking somebody from 3.5% and bringing them to 4.5%. Which begs the question, what happens if interest rates actually were improving? If your customer saved 0.75%, or if they had mortgage insurance, what would happen? Well, in this particular case, you would put them in a wonderful position where it'd be closer to $375,000 and just 12 years left on it. This is a real life scenario I want to bring to your attention because it's near and dear to me. I want to tell you about my landscaper, who's just an incredibly wonderful man and a good friend, who is one of the top landscapers in New Jersey, but unfortunately contracted Lyme disease. Made lots of money, but now found himself struggling. And I don't have to tell you because the credit card offers are abundant and there's no shortage of people that'll shove debt down your throat. And so Gary put himself in a position where there was a lot of debt. And that debt became an incredible burden. Even though he was making a lot of money, the amount of debt, this is actual, was $28,000 a month. You heard that right. $345,000 in outside debt, $28,000 a month. Now, thankfully, this wonderful man was able to put himself in a position where he could afford the payments, but it didn't leave him much after that. And there was one day he was actually working on my home where he just didn't look like himself, and he had this burden on his head. And I said, Gary, talk to me. This is kind of what we do. Took out the debt consolidation tool and MBS Highway and actually plugged in these exact debts. He got his wife on the phone and we went over it together. And then fortunately, like so many of your customers, he had equity in his home. We said, what if we did a refinance? And what if we were able to pay off all these debts and build it into your mortgage? Gary's saving $26,000. That's right, $26,000 a month. Now, Gary had been in a position where he was so upset with this debt, and it was such a weight on his head. I said, Gary, here's the plan. Here's what you're going to do. We're going to save you $26,000 every month. But what I want you to do is this. I want you to take $10,000 a month. I just want you to blow it. I want you to go out and have a good time. Now, you and your wife, enjoy yourself. Treat her great. Treat yourself great. Spend an extra $10,000 a month on you. Spoil yourself because you enjoy it. But you know what? That extra $16,000 a month, I want you to make believe you don't even have it. I want you to take that money and apply it towards principal. And by doing so, Gary applied the money towards principal and will pay off his entire mortgage in just 2 years and 2 months. Wow. Debt free. giving him an extra $465,000 in net worth. Just 2 years and 2 months. Same payment he's making now. It's actually less because he's got $10,000 a month more disposable that he's blowing and enjoying. But just 2 years and 2 months. I'd say it was so touching and wonderful. It was an emotional time. Gary was emotional, his wife was emotional. I got choked up because you're changing people's lives. But the part that really touched me was when his kid thanked me for helping his family and changing their life. That's the chance that you have every single day with what you do. You have this gift, this opportunity. You know, I want to tell you that success and goals for success are very important. You need to have those because that keeps you on pace. But there's a lot of successful people that aren't very happy. And we know that. You hear about famous people all the time, and there's some sad stories out there, but just people that in general might be successful, but just not happy. And I truly believe that's because they lack fulfillment in their life. And fulfillment really comes from helping others, changing people's lives for the better. If you have achievement of goals with fulfillment, well, that's a really good way to be happy. And I think that you have that opportunity every single day when you go out there to talk to people. You never want to talk to people from the point of view of making money, doing a deal. But talk to people from the point of view is how can I help you? How can I change your life? That's what's so powerful about this knowledge, because it gives you the ability to truly change people's lives for the better, to give you fulfillment. And the money just comes. You can't help it. It'll follow you. You don't think that, yeah, I will tell everybody now, I don't do loans anymore, so I have to give this loan to someone else. But this is the type of thing that they tell everyone about. You have that chance and that opportunity every single day. Now, some of you might say, you know, will somebody go back out and recharge their debts? It's possible. You hope that the education helps them, but at least you give them a fighting chance. That'd be like a doctor saying to somebody who has high cholesterol, well, they're just going to eat ice cream anyway, so I'm not even going to tell them to do anything right. So, of course, you want to do the coaching and the counseling. And many times you'll change people's lives for the better.
Any questions on that one?
I actually had 2 questions, and one actually goes back just a little bit. I'm sorry if I missed the beginning, so I don't know if it's a dumb question. So right now, let's just say that, or I guess I can ask you later if you want. I don't know if I'm gonna run on. Okay. So at the beginning, it's talking about the whole amortization schedule, and if somebody's going to do a refi in the true break-even amount. If somebody comes to me next year and says, hey, you know what, I'm going to sell this house in 5 years from now, would it still be more helpful to go back to that old way of doing it just because we're not going to look at that full amortization schedule over the next 30 years? Or would it, like, that break even be more relevant of the 5-year period of time?
So it depends on again, your audience. So I will explain it to people that will understand it, but I won't dig into it with somebody that is going to confuse. But I will, if somebody wants to refinance and they're going to only stay in that property for 5 years, I'm going to be cognizant of my fees. So I'm going to probably give them a little bit higher of an interest rate to try to cover the closing costs. Because if I can save them anything in interest, like $1 in interest, and they don't pay any closing costs, then there's no downside. There's zero. Literally, they could refinance 8 months from now, as long as they're, and incur fees at that point, but they didn't lose. So if they're only in the loan for a certain amount of time, now you may want to do that. I like to do it personally, just to make sure that I'm putting somebody in a better position. Because there's a way, I mean, you can really justify pretty much anything if you want to sell it. Me personally, people work with me, I think, because they trust me and they know I'm going to always do what's best for them, like in their best interest, and they trust that I care about, giving them not only education, but putting them in a better place. So a lot of times when I do a loan for somebody, I might be increasing, like when I sold that one from 3.375 to 5.375, I told her, hey, this is step 1. I mean, we're going to pay all this stuff off. You're going to get the extra. Part of that was for renovation, like she's finishing a renovation that she ran out of money on. And I told her, we're gonna refinance this. This is step 1 of the refinance. We're gonna get you, we're increasing your rate and everything, but hopefully we'll refinance a year from now or so, maybe get a % lower on interest rate. Then your monthly payment will go down and we can reapply that. But always try to put yourself in their shoes. And if you start getting too complicated, if you start digging in too deep and you go like, you're going to lose them. And then you just want to make sure that they're following along, but you're also doing the right thing. So
Okay.
you may want to do that calculation yourself just to make sure you're still putting them in a better position based on their timeline, but
Yeah.
you may not want to explain it the same way.
Okay.
If your break
If it
even is
does-
3 years, then if it's gonna be a 5-year plan, in 3 years, you know, you still have 2 years worth of savings for them.
Yeah.
Exactly.
Okay.
It's the
That's
same
nice.
thing. It comes up more for points. Like when when people are deciding whether or not they're going to pay points, that's where you're probably going to see this most often.
Okay. And then the second part was going to be, right now I've got somebody with an FHA loan and they're going to sell and gotta be contingent, obviously, and get another FHA loan because still not doing so great as far as their assets go. Is there a way for me to access that calculator to show me everything? Because I mean, they've got 2 different student loans, they got credit cards, car payments, try to.
Well, so if they're going to want to buy a new house, FHA.
Yeah, so when they sell their current house, they're gonna have $107,000 on the low end. They might have up to about 125K in their pocket afterwards. And I'm trying to figure out what's gonna be their best option as far as like what they should pay off and how much they should put as their down payment. Because right now they're not comfortable with going over $1,800 a month. You guys are in a different state than me. Missouri's a little different over here, but $1,800 a month is at most where they're comfortable. But if I remove some of their other debt with those assets, then it might be comfortable with $2,500 a month.
100%. So what you're going to want to do is you're going to put those, if you should have Mortgage Coach. Mortgage Coach, there's a little bit of a learning curve. You're going to have to figure out how to do that, but you can use their debt consolidation tool within Mortgage Coach. If not, like if you don't want to learn that yet, or if you guys don't have access to that yet and you don't have logins, you can just do it on an Excel spreadsheet. So just an Excel spreadsheet, break down their monthly payment and their other debts. Just say, hey, we're going to allocate this amount from the net proceeds of your sale towards paying these debts off. And just show, okay, your monthly payment, your monthly bills are going to go down by $400 a month. So if we're increasing your payment on the mortgage by $400, you're still going to be about the same. Now they may say, okay, well, I only have 3 years left on the car and I don't know how many months I have left on the credit cards or whatever. Just tell them, hey, if you can afford the monthly payment right now, are you gonna be happy? And then you would go into showing them how the mortgage, I don't know if you remember, they sent out this on the leveraged investment, but showing them that buying a bigger house is going to leverage their money even more, like and wealth. But yeah, Excel's an easy way to do that. So just put what their payments are right now, plus all the bills, what their new payment would be after all that's paid off, and then just allocate part of the net proceeds towards paying those off, and then put the rest towards the down payment or with a cushion, whatever. But that, if you want to juxtapose those, Excel's a really easy way to do that.
You might be able to, if they pay off the debt, they may qualify for a conventional, not an FHA, so the pricing of their payment will be better too.
And they won't be able to go FHA.
598.
Well, I say FHA 590. Yeah, there's not. Oh, I mean, run AUS, because if you have 2 borrowers, it will average the scores, not for pricing, but for.
I got a foreclosure on the second person, and they're at like a 562. So I'm using only the husband.
You could do a what if scenario, see what would happen if they pay off the debt just on the credit score.
Through Advantage Credit.
Yeah,
just make sure that they
understand
understand that they are going to have to sell that house beforehand, because you can't. I mean, you're gonna have to meet the 100-mile rule with FHA.
Yeah, I've had those discussions, and Lacey's helping me at that little bit. And just more trying to. It's kind of, I don't know. I just want to sit down with now on that spreadsheet and really just look at how things are going to affect them, because I'm kind of getting my mind blown right now looking at all these numbers across my screen, because I'm still new to all this.
Oh yeah, it's gonna be overwhelming, but just go back through like the study material. Like, you got a copy of the book, right? Like the PDF.
Actually, I printed it off, so I got it all.
Yeah, so I mean, just go through some of the examples there. But yeah, just next time if you have any questions, bring it up on our coaching call, and we can go over that with everybody too. As I'm probably going to send these videos out to all the other students on our call. But it's been helpful, right, so far?
This is awesome. Yeah, it's blowing my mind. And what's that calculator called? Because I'm gonna look it up too. That mortgage one.
It's the mortgage coach is a system that we have.
Okay.
And it's actually built into Encompass, so like you can literally click on like whatever loan scenarios you want, and it'll actually build it out. You can build them out in the mortgage code once you have it set up.
Awesome. Thank
Yeah,
you.
it's simple. I see that all the time.
Yeah,
It's-
Yeah, it's not, I mean, yeah, it took me a day to figure out, to learn it,
You're Josh with it.
but yeah. I mean, most people will take like a week or so,
Okay.
but all right,
About a week then.
see you guys later. See you
All right,
next
yeah.
week.
I'll cut
Thank
that
you
in
again.
A month, maybe 3 days.
Alien said, I was like,